Well, good afternoon, everybody, and welcome to the latest update on the Nursery Industry Stats and Benchmarking Tool project. My name's JP Van Mort from ACIL Allen, and I'm joined by my colleague Marshall Roberts to work through what last year's results show us and to give you a live demonstration of the tool and the latest amendments that have been made to us. We're expecting about 30 or 40 people online today. We've got about 20 of you here to start off with. So I think we'll get straight into it. So for today's agenda, what we've decided to do is work through a process of just sharing with you what the latest results were from last year, to where the trends and what some of the headline benchmarks are telling us about where the industry is going. Then Marshall's going to lead you into an overview of the tool, the latest improvements that have been made to it, and just work through to remind us all how to use it, or for those of you who are joining us for the first time, how to get started with the tool. Then we're going to give you two practical examples of how you can use the tool to interpret certain improvements you might want to make to your business. And then finally, we're just going to have some questions along the way and do a poll on thoughts about where the tool might go next. We'll feel free as we break at the end of these sections to pop your questions into the chat line and we'll pick them up, or otherwise when we formally close, you can switch your microphone on and you can ask us a question directly if you prefer to do it that way. Righto, so what did we learn about the industry in the last collection that we did?
Okay. All right, thanks, Peter. Bye. Bye. Bye.
Okay, so just to remind us what this project's really about, first of all, it allows you to benchmark your business, but also to use it for many different things. It's a great snapshot to just track where the industry is trending, to keep your eye on the ball. You can compare yourself against peer-to-peer businesses based upon revenue size. You can really get in there and do time series analysis on how your product and market segment is changing. You can use it for continuous improvement, looking at the financial operations of your business, identify growth opportunities, or to pull it all together into a SWOT or some other technique you might use to improve your business. When we look at the stats, these are the headline stats we got out of the collection for last financial year. So this survey was done in spring last year, but drawing on the statistics from the year before. So we saw a small reduction in the number of nurseries we identified to slightly under 1,600. Sales have recovered from the slump after the industry had been experiencing a modest amount by 3.1%. And 71% or 69% of the businesses still have a relatively small turnover of less than $2 million per year, which is slightly down on the year before when it was 71%. The industry remains a strong employer of people with about 18,961 full-time equivalents, and there was a nice positive return to profitability with an increase from 71 to 79%. And also positively, 89% of businesses expected to make a profit this year. Employing a lot of people, the wages bill was about $1.4 billion, which is an increase reflecting those increased costs there. And we've seen a modest investment and also an increasing investment in technology and infrastructure across the sector. When we look at some of the average values rather than the headline stats, we see that the average value is $1.6 million and the median is only $0.8 million. So it just says there are a lot of small businesses still trading successfully inside of the nursery sector. Similarly, we have a bit of a skewness on wages, where the average wage bill is $728,000 against a median of $430,000. Similarly, again with operating costs, average operating costs of $1.4 million, a median of 0.8. 8.5 FTEs average, a median of 8, and 3.2 hectares area, both indoor and outdoor, against a median of 1.7. Another way of looking at these statistics is to break it down and look at some other ones that we can generate. So we've seen that overall, if you include all businesses, so these includes the small ones who don't sell to big box retailers or anything at all to them, 17.3% of sales were to big box retailers, only 6% for small and 42% for large. So different businesses in the industry have taken different positions against the large retailers. The wages to salary ratio is 41%, which is quite competitive. It's much smaller with the large ones who make more use of technology and higher in the small ones. An operating cost to sales ratio gives you a rough gross margin of about 20%. In other words, 80.1% is spent on operating costs. That's not too different across the different size businesses. The average spend or the average sales per FTE is $170,000 and much smaller with the small ones at 101 and above $250,000 for the larger businesses. And turnover is $455,000 per hectare. On average, for a small business, it's $155,000 and nearly $750,000 for the large ones. So I think what we're seeing is the industry's stabilising. There are pressures inside of it. There's a modest uplift in revenue and expectations around profitability. But on the whole, not back to the really strong days we saw before COVID overall. I'm now going to hand over to Marshall, who's going to take us through the benchmarking tool demo, and then we'll pause for questions. So Marshall, over to you.
Thanks, JP, and welcome to everyone who's joined us online today. I'm now going to introduce the benchmarking tool for those who are not familiar with the tool, some of the updates and a quick refresher on how to use the benchmarking tool. So we jump into the next page, JP. So this is the benchmarking tool interface. It's an Excel-based tool as it has been in previous years. Within the tool, there are 12 tabs or pages of data across various topics. Across the contents, I'd ask that you focus on the inputs and summary results pages. I really see you getting the most value out of those two items within the tool, and then you can analyze other topics and benchmarks within the tool as you need to. Some new data in this year's benchmarking tool, within constraints, we can see the different types of technology used by businesses in the industry to really address some of those cost pressures, and there's various information within that tool to reflect the latest survey. There's also some various updates to the other topics. We've tried to simplify this year's tool, make it easy to interpret, and we've cut down on the amount of content within the tool. Like previous years, data is presented across 4 turnover categories, ranging from small businesses up to large to enable you to compare yourself to your peers. Data is also presented as a lower, middle and upper values, and this will then allow you to compare yourself to those who are maybe performing a bit stronger in various areas or just against the average in the industry. Like previous years, you enter data into dark purple cells and the grey cells are outputs. If we jump forward into the input sheet on the next page. So this is the input sheet, and I'd just like to refer to a few areas on this page as indicated by the key on the left. So referring to item 1 on the page, you can change who you compare yourself to within the industry by sales or turnover size. So as this shows, we're comparing ourselves against businesses with a turnover between $2 and $4 million. Referring to item 2 on the page, we've entered data for the latest year, And within item 3, we can see there are 11 input cells, and this will generate summary level results on the next page. So on this input sheet, we simply ask you to enter sales, sales to big box, different product types, production area in hectares, your operating costs and your wage costs, and the number of people you employ, and lastly, the level of investment. And using this data, we can generate various benchmarks, as we'll see on the summary results page. So excuse the level of detail on this page, but just referring to a few key areas. Item 1 on the summary results page, that's essentially your data. And this is split into headline benchmarks, but also operating ratios down below, which are calculated using your data. At item 2, the benchmarking tool compares how much you differ from your peers, and this is presented as a percentage based difference. Referring to item 3, this column shows the median values of your peers, and you can compare how you differ to them. At item 4, we can change and toggle within the tool. We can present lower, middle, and higher values. So I think this is where you'll probably gain the most immediate insight from the benchmarking tool. And just to remind you, 11 inputs will generate around 20 key benchmarks for your business. If we move forward to other results you'll see within the benchmarking tool, just next page, JP. Yep. Here we can see how data is presented within the tool. On the left, we benchmark you against your peers as in terms of percentiles, with the lower grey indicating lower values, the dark grey indicating the middle 50% of values, and the dark segment being the top 25% or higher values. In the centre, we can see how we trend against our peers in terms of operating costs, including wages to sales over time. And thirdly, on the right-hand side, here we show your business indicated by the blue dash against lower, middle, and upper values. So this is what you'll see within the tool, and hopefully, visually, you can take away clear and immediate insights from the benchmarking tool. So if we move forward now into some applications, and we're going to demonstrate how you might use the tool in terms of 2 short case studies. So this will hopefully enable you to see how you might use the tool, interpret your results, and generate actionable findings, focus areas, or strategies for your business. For the first case study, we present a business that's scaling for sustainable growth. So this business is showing steady growth in sales with gradual shifts from losses to small but improving profits. This business is expanding through support in retail channel growth and investments they're making. However, they face some cost pressures. So let's have a look at this case study. So here we can see the range of input data for this business, noting this is just for demonstration purposes. So this business has been able to enter data over the complete time series. However, this may not be possible for all of you to do, but we're presenting a complete picture here of how this business has changed over time. So we can see this business is in the $2 to $4 million sales range, and in the latest year they had sales of $2.4 million. They've got a presence selling to big box retailers. Their production area of around 1.8 hectares, operating costs of $2.5 million, and of that amount, 1.3 was wage and salary costs. They've got about 18 full-time employees, and we can see consistent investment over time in infrastructure, but less so in technology. So if we look at the results for this business, I know there's a lot of detail on the page, but I just want to direct you to a few key areas on this slide. So firstly, as indicated by the red one, an arrow, we can see that this business is comparing themselves to peers of similar size. So we're making a like-for-like comparison. However, we can see that immediately we can see some operating cost pressures. At item 2, we can see that this business is employing 26% more employees on a full-time basis than its peers of similar size. So relatively around 4 to 5 more full-time employees compared to businesses of similar size. At item 3, we can see their production area is a little bit smaller than their peers. And at item 4, we can see that their operating cost to sales, which includes wages, of 104% is around 21% higher than its peers. And this indicates an operating loss in this current year presented. At item 5, we can see turnover per full-time employee. We can see that this figure is 28% lower than their peers, which may imply some level of overstaffing, but certainly something to flag for this business. At item 6, we can see a high level of turnover per hectare. So we can see this is quite an intensive business, high turnover, low footprint operation. So if we look at some key trends for this business, we can see consistent sales growth over time. We can see that their sales are approaching the 25th percentile and median within this sales category. To the centre, we can see wages to sales ratio. We can observe a decline over time, which is a positive sign. This ratio for this business has essentially met the median rate, so this is a great sign, and implies that sales growth has outpaced wage growth for this business. Thirdly, on the right-hand side, we see operating cost to sales ratio. A few good years, around 80 to 90%. However, in the latest year, we can see it's surpassed 100% for that operating loss in the latest year. And we can see a gap has opened up between this business and the industry median. So certainly some non-wage cost pressures for this business, something to focus on. If we move forward to the next section, we'll have a look at employment. We can see that this business has hired more staff over time, reaching around 18 full-time employees in the latest year. So we're now positioned above the median. However, we're still below that 75th percentile or higher value, which is around 20 to 21. So we can see we've got a slightly larger workforce compared to our peers, but it's still within an acceptable range compared to others. To the centre, we can see stable sales per full-time employee. So no noticeable change over the time series. And this is a positive sign given the increase in employment levels. So essentially a sustainable workforce is indicated here. Finally, we can see, so taking all the data and findings from this business, we've conducted a SWOT analysis, which is maybe something that you might consider. Essentially, this business is experiencing strong growth, consistent growth, high land productivity, supported by investment and retail growth. However, we see it being less efficient than its peers in terms of labour productivity and cost structure, essentially with rising operating costs, especially in the last 2 years. So in terms of strengths for this business, we see obviously strong and consistent sales growth is a great sign. They're using their production area and land very efficiently with a high output per hectare. So this may enable them to expand. In terms of weaknesses, there's a key concern in relation to operating costs, which are persistently high, and we've identified non-wage cost pressures over the last 2 years. There seems to be a limited investment in technology, which may be impacting efficiency. So this is also an opportunity. In terms of opportunities, they should consider diversifying their product range. Sorry, JP, we've just, yep, there we go. We see they could diversify their product range as they only sell one product. We think they can build their land productivity to scale even further. They should review their cost efficiency to try and close that gap with their peers. And the threats, quite obvious, but the rising costs, eroding margins, and their competitors or peers seem to be more efficient in terms of labour and cost management. So there's a number of areas we've identified here, but hopefully this gives you an indication of how you might use the tool and develop strategies in response to findings and insights from the tool. I'm going to hand back to JP to walk through a second example.
Great, thank you very much, Marshall. Before I go on and do the second case study, does anybody have any questions they'd like to ask of Marshall or I around the tool or the case study? All right, I'll keep going. But don't forget, if you have a question, any question is a good question, type it into the chat or ask us when we pause next. So the second case study, and as Marshall said, we've drawn these case studies from real data from real businesses. We're looking at a business that's driving efficiency through productivity gains rather than looking at growth. The other thing is, yes, we've got one question saying, will the recording be made available? And the answer is yes, it will be. So the second one is, this is how somebody has improved profitability by focusing on operational efficiency rather than expansion, using technology and workforce optimization to get its output levels up, using the same levels of inputs that they had beforehand. So to familiarise ourselves with the framework, again, this is one that an example with all of the work data, but you can just use a single year's worth of data to get the same sort of insights as you compare yourself against your peers and understands what it means. In this case, we have a smaller business operating in the $500,000 to $2 million range, and just working down the column on the right-hand side, you can see it's running about the same at $1.1 million last year. It sells a third of its produce to big box retailers. It sells 3 different types of products. It's got a 0.55 of a hectare of indoor and 0.65 of a hectare in outdoor production. Its operating costs are about $880,000 a year, $570,000 of wages, 9 employees. You can see if you look at that one, that the employee numbers have come down a bit, but FTEs again have come down, and they're investing less in infrastructure, although than they have in past years, but they have invested a bit more into technology as they've moved forward. So then when we pull this together into this summary chart, and again, I think the key thing is when you look at this chart, a couple of things to keep an eye on. One is you've got the middle section where you've got the bar graphs, which just gives you an eyeball whether things are, blue says you're higher than the benchmark, grey bar say you're less than the benchmark, and then if you look at the column on the right-hand side, you can compare the numbers of your business against the revenue category you're in and the industry overall. And so in this example, just pulling a couple of half a dozen key points out. The first thing is that this business employs 7 FTEs, which is a couple of people higher. So that's number one. Number two, the total production area at 1.2 hectares is 25% lower than its peers. When you look at the product sales category, looking at the average, it sells a higher range of products, so it scores a higher benchmark on that. And its wages to sales ratio, this is moving into the bottom half of the chart here at number 4. You can see they're 17.8 percentage points higher, so they've got a higher wage structure than benchmark businesses. And their operating costs to turnover ratio, on the other hand, are slightly more lower, which is efficient in this case at 1.8 percentage points. And then finally, the turnover per hectare, that this is a business that really is getting a lot of turnover per hectare compared to its peers. Turning this all into charts, you see that what this business has done is it's moved its sales up incrementally over time, probably really only keeping up with inflation at best. And that the wages to sales, they're holding, you would say, inside of that, but they're still outperforming their peers. So in this case, they're sitting in the top 25th percentile of comparable nurseries. And what they have done is they've been able to get their operational, their OPEX, including wages to sales ratio, down from being much higher to closer to the median of the industry, which is a positive development for the business. So they've done this partially by streamlining their headcount, which has kept them, still hasn't put them into the 25th, into the top quartile, but they're going pretty well, and they're above the median or the average for the industry, and their sales per FTE have gone up. So sales per FTE in the middle chart here is a positive development for the business, but compared to their peers, they're still haven't been able to lift it up to where they're really competitive against some of their benchmarking businesses. So this is a business that's looks like it's very focused, very disciplined, and what we see here is pulling it together into a SWOT. It strikes us that what you see is strong control over operating costs relative to sales growth, so that they're focusing on managing that. And they're getting more efficiency out of the workforce, so that's driving productivity growth, which is key to remaining competitive and profitable. The overall sales growth is limited, and so they haven't really scaled revenue or sales as such, and that may not be their intention. And they've maintained a modest level in technology, which suggests that might be something there, or could actually be a capital constraint that they face in sourcing the funds to invest in technology. And that they still, compared to some of their peers, have a narrow product range, so there may be some opportunities to grow different things for different clients. The threat is that a third of their revenue is exposed to major retailers, so they're caught in the price competitiveness in that segment of the market. And obviously cost inflation, like with many businesses, is something that could erode into profit margins. So the opportunities are to identify some categories where there's higher value and shifting into that, or to look at things where they can scale using their workforce or their modest investment in technologies to see how they can scale up without changing their cost base significantly in the process. And I'll pause here and say we would love to see answer some questions for you. We're well ahead of time, and just ask us any questions. We'd love to answer them. You must have done a fantastic job, Marshall.
Yeah.
All right, let's go into the last part of the presentation. This is an interactive thing we've designed. So this project has been going for 5 years, and the nursery benchmarking project has been going for 10 years. And so it's been an ongoing collaboration between ACL Allen, Down to Earth Research, who many of you will have engaged with as part of the data collection, the Green Life Industry Association of Australia, and the Hort Innovation Nursery Fund as part of it. And this is the final webinar, final data collection under this contract at this point in time. And we've learnt so much about the industry and what's really going on. And we've had so many wonderful suggestions about what we can do with the statistics and with the benchmarking tool going forward. So what we'd like to do now is actually put up a poll to you about some of the half a dozen key ideas we've heard and seen which ones you place the greatest amount of value on. So I'm just going to explain the poll to you, and then Emily from Green Life Industry Association is going to deploy a poll which you can then complete on your computer or on your phone to tell us what you think is important going forward. So the first idea that we've heard is, and we're keen to explore, is whether people see value in when Dan releases the benchmarking tool every year, whether it's pre-populated with your own data. So instead of you having to enter it, we'd grab the data we have in record, and then you'd receive the Excel spreadsheet with your own data. Obviously, we're only scratching the surface really of the industry in terms of the various costs that production nurseries have, or the various priorities and people are chasing. So we could focus on expanding the number of cost items and priorities that we explore in the survey every year. Another suggestion has been that could we create an online portal where people can just log into the tool, which could be designed and might be in a bit of software that integrates with the software that you use in your business. The fourth one is that we actually put more effort into understanding the sales statistics, in particular who buys what. So the different product categories, the different channels that the industry works through. Apologies for getting the brackets around the wrong way there. We know there's deep interest in saying, can we generate data at a state level? Can we generate the benchmarks at a state level? The last one is also, another one is we, for people who are interested, is we run peer-to-peer data sets. So we crack out the data for industries who agree to share their individual results so you can benchmark each other on a business-to-business basis rather than on a category basis. It's not for everybody, but we're interested to see whether somebody might be interested in getting to that level of sharing. And of course, there are many, many other ideas. So I'm going to stop it now. And then if you can go to the chat function on the computer, there's a slide there that says vote in Slido. And if you click on that, we ask that you look at those priorities that are up there and you rank them from most important to least important. So number 1 is the highest priority. Number 2 is the second highest priority. If you have another idea, please use the field that's in Slido to type in the ideas that you have. We'll give you a couple of minutes to do it, and then Emily's going to share us the results. So happy ranking, everybody. So Angela says it's not working. How are we going with this, Emily?
Hi, mine's not working either. Mine is saying my version of Teams isn't available and they're working on it, so I can't text, I can't write or enter the poll.
All right, well, why don't I'll put the slides back up, and then why don't we talk about it while somebody sorts out the technology in the background. Let's get practical about this.
Sounds good.
While we wait, JP, I can see that 10 people have voted.
Okay. So the gentleman who spoke before, and I've put those things back up, which one's the most important to you?
Will be number 3, benchmarking tool available online.
Okay, so through some sort of portal?
Correct. Probably followed by number 2. Oh, sorry, the first one, the benchmarking tool preloaded with your own data.
Yep.
I think that would be great.
Thank you. There's somebody else who's online who couldn't vote. If you want to pass your comments through verbally, that'd be great. Thank you, Angela. Online own data as well. All right, I'll just give people another minute and then we'll look at the results that have come up. Thank you, Palm Park. So number 1 is preloaded with my own data. And sales statistics. All right, Emily, are we ready to share the results with everybody?
Yes, we are. I'm just getting them up. I think I'll just share my screen. Can you see that in the corner here?
Yes, we can. Okay, so number 1 was preloaded with your own data. More production industry costs and priority benchmarks. Number 2, more sales statistics. Number 3, benchmarking tool available online. Number 4, state level stats. Number 5, peer-to-peer 3, and other. Probably looks like about. We'll pull out those comments later on. So, so we understand, obviously preloaded and online pretty well. And I saw that one was actually more benchmarks on nursery costs and priorities. For the people who had listed that as a priority, could you tell us the specific priorities or costs that you'd like us to investigate in particular? So inputs, so freight costs, potting mix, etc. Thank you very much, you two. Buying propagation material. Thanks, Mark. And some Angela said comparison is not always about larger companies, but there may be some local cost or distance challenges. Indeed, that's very true, such as finished plugs and tubes. I think that's one of the things we've learned over the years is, there's so much variability, and designing the questions in a way that we can generate some benchmarks that take on board the amount of variance that exists across the industry, so that we can generate meaningful benchmarks for you. So, final question, and then which is, and so it's regional based analysis, and that's always the challenge we have in this project. If we get enough response rates from various people, we can then crack the data down into smaller groups. But quite often, particularly at a regional level, we just don't get large enough response rates within regions to really crack out benchmarks that are statistically reliable. But it's something that we always work on, and certainly is going into the design thinking for the next round. And so my final question to you as an audience, and thanks for your patience, is if we have more sales statistics, which is the third highest ranked one, are there specific aspects of sales you'd like us to explore? Is it channels, plant categories? What is there something specific that people are interested in?
Good afternoon. This is Kui from Suncoast Water Gardens.
Hello, how are you? Yes, we can.
Okay. I am very frustrated with this fuel levy. I think a lot of it is opportunistic, because I ordered a lot of bark recently, and the fuel levy was $300 odd, which is 12% of the cost. Now, it doesn't cost that much to deliver. I can say, yes, your delivery fee is, say, $300 or $200. The fuel levy should be 10% of that $200, $300, not 10% of the cost of the invoice. So I would like to see how much of this fuel levy impact on our profitability over time.
So, and I think you're right, Koi. We've heard again and again over the last 5 years how sensitive nurseries are to input costs, and at the moment it's fuel, and then in the past it's been water, power, and exploring those and how they vary. There's also been suggestions on pots and propagation as well.
Also to what do you call it? To keep an eye on it. The levy is on the cost of delivery, not on the cost of the invoice.
Yes.
So this is a very opportunistic situation, I believe, that a lot of providers are taking advantage of.
It's something that's going on, and I think, but then this is a survey of all costs around the industry rather than an investigation to that. So we can look into it in part, but not in full. So just a qualified that's there.
Like I said, in next year's data, we should see how much impact the fuel levy has had
on the industry. Absolutely. And then Mark, you've put up channels. A big customer segment for most nurseries is the brokers landscape, and this doesn't seem to be a clear category. Yeah, I think there's a lot more design work that can go into the channel structures, Mark, and that's something we're going to write in the final report about thoughts about how that could be investigated. All right, any final comments before I give everybody 15 minutes back from their day? All right, thank you very much, everybody, for spending your lunchtime with us today. Couple of things here. First of all, I'd like to put out a great thank to all of you for participating, not only in today's webinar, but also in participating in the survey, because without the data that you give us, we couldn't generate the benchmarks that are there. And also a big shout out to the team at Green Life, Down to Earth and Hort Innovation, who are collaborating and have been collaborating with us over many years to make this project happen and to generate these valuable results for the nurseries. So we're going to send out a short survey afterwards. Please complete it if you can. And I wish you all a fantastic afternoon. Thank you.
I think there was one more question in the chat.
Oh, sorry. Oh, North Queensland indoor plants. Yes, we will check, or please get in contact with Green Life Industry Association or email back to this and we'll make sure you get a copy of the survey if you haven't received it already. All right, thank you, everybody.
All right. Thanks, everyone.
All right, I think we're done, Emily. Thank you.
Sorry, I was on mute again. Thank